My name is Andrew Stonson. I want to welcome you to the Valuation Master Class Show. I'm here in beautiful Bangkok, and look, it's snowing. Well, not really. I was looking at some of the fun things we have here, like some little Christmas ornaments as an example, some other fun stuff. Today, we're going to be talking about applying FVMR to assess a stock's attractiveness. We're going to look into two companies in China, Trip.com and Ceres Group, which we're going to compare and contrast, and then we're going to learn sector and industry impact on valuation. Before we get started, one of the things that I learned as an analyst very early on was that there is really no comparable company. One of the big things that people try to do in the world of finance is say, what are the comparables? You're never going to find a perfectly comparable company. And I think I've seen a lot of people get stuck in that situation. So when you're comparing companies to each other, or when you're looking at a company, you can compare it to another company, or you compare it to maybe other companies in that sector, in that country, or globally. Now, for me, I like to look at a global comparison of all the companies in that sector and that industry as a way of getting a benchmark. So today you're going to see the ability to do both, compare side by side with other companies and compare against the aggregate. And you're going to see in the case of one of these, there's a big problem caused by Tesla that you can't compare. So we're going to go through that. Before we get into it, the Valuation Masterclass Show is sponsored by Valuation Masterclass Bootcamp. The next bootcamp starts February 16th, and you can learn more at valuationmasterclass.com. And VMC Show members get an additional $100 off. So become a member by just messaging me with VMCBC at me at Andrew Stotts. And also you can message me to get this presentation. We're building a list of people who are interested in valuation and interested in learning, and I'm happy to have you on that list, and let's keep going. I started this a few weeks ago, and I would say I'm really enjoying it, but more importantly, I'm enjoying the questions that come in and also the messages. Gotten great emails from you talking about your own situation. That's fascinating. So let's get into the material. So remember my FVMR framework. First is fundamentals, where we do an assessment of a company's financial health and business performance. And the second is V for valuation, and that's an estimate of a company's worth based on financial analysis. And third is the M, which is momentum. So momentum in earnings and momentum in price. And fourth is risk, the potential for loss based on a company's financial stability and its price volatility. Now, this is the framework that I've been using for many, many years, and it's not some crazy breakthrough. It's just a way of framing the way I look at things so that I never miss these four factors. Try to think of it like a square or a rectangle. We're going to look at a company in the middle and try to assess how good it is on these four factors. And the reason I started doing this many, many years ago is because I remember getting caught in value traps. And I thought this stock is really cheap and it's going to go up. But I didn't pay attention to other things such as risk or momentum. And this helps me stay focused on that. So also remember, you can get this global stock tracker by just emailing me at Andrew Stotts with GST, and then I'll make sure that you get it. And basically every week you can get this updated global stock tracker. It's the tool that I use to track the attractiveness of the top 500 stocks in the world. This is not easy stuff to get, and therefore, get it. Now, I do want to highlight, you can see on the right side of this FVMR rank, where I'm ranking each company relative to the others within that sector and sub-industry. You can see at the top, consumer services is the sector, and the sub-industry is media and entertainment that you're looking at right here. You can see the list of companies and their rankings. Now, I'm showing two different factors under each of FVMR, but there's many more. We don't have to just use net profit margin and ROA for fundamentals. I use many different measures, and we don't just use PE and price to book for valuation. I use many different measures, and we don't have to use EPS and price change, in this case 3-month, but we can look at many different measures of momentum and risk. I have both net debt to equity and I have beta. So you could say fundamental risk and price risk. And those are the, let's say, 2 per the 4 factors. And we can see that's 8 factors that we have listed here. At the top, you'll also see that I've aggregated the sector and I've market cap weighted it. So you can see that Alphabet is the top company on a market cap weighting at $3.862 trillion. And therefore, its net profit margin, its PE, its price momentum factor in very high compared to the one at the bottom, Naver, which is from Korea. I believe that's the line. The company does line. And that has a market capitalization of only $26 billion US, and therefore it has a much lower weight in the calculation. And the other thing I just want to highlight for a moment is that the FVMR score that I use when I'm looking at stocks and allocations is a pretty in-depth measure. I've done a huge amount of back testing and accumulation of factors, not just the 8 factors that you see there. And the listing that I show from 1 to 24 of the FVMR ranking doesn't necessarily mean it's going to outperform. It's just saying of these 8 factors, this company's accumulation of those factors is ranked number 1, as in best. And that's all it's saying. It's not saying it's a buy or a sell. So we can see that ranking over on the right. So let's now dig in. So valuation ratios should be used together, right? A good valuation or a good attractiveness level, like an FVMR rank of 1, is not defined by one ratio. PE, price to book, must be viewed together and in context of its sector. And let's talk about Ceres Group. This is a Chinese company. It's an automaker specializing in new energy vehicles, and it designs, manufactures, and sells electric vehicles and the components related to them, like batteries and motors. And it's competing with BYD and NIO and Li Auto and XPeng and Tesla. It's such a competitive space. Now, I took that picture from the website, just looking at what they're up to, and just the level of automation is just crazy of what's going on in China. So hard to compete with that. And this is just, their production line right there. And the company is traded on the Shanghai Stock Exchange. And let's now look at the next company that we're going to consider in this comparison. And they're very different. And this is what makes comparison fun, is when you find very opposing companies. So the next company is Trip.com, which is dual listed. It's in Hong Kong and it's in the NASDAQ. And it's a Chinese online travel agency that offers flights, hotels, trains, car rentals, and vacation bookings worldwide. And it competes with Booking.com and Expedia as examples globally. It's a website. Now, so here we have 2 different companies. One is a capital-intensive manufacturing company, and one is an asset-light tech company that can expand by just, expanding to get new users on its platform. But for the capital heavy company, they got to invest a lot to expand. So we have now 2 companies that we can compare. So now let's go into what we can see if we look at this, the global stock tracker. So first, we're going to look at Ceres, which is in the sub-industry of auto component sector within the consumer discretionary. And you can see it at the bottom. It's ranked, this table is ranked by market cap or size. I don't show the market cap in this, but it's a relatively small company compared to others, but it is ranked number 1 by this very simple FVMR ranking. And let's look at trip.com. Now, it's in the consumer services sub-industry within the consumer discretionary sector. You know, discretionary meaning if you don't have money or the economy's bad, you may postpone your trip. And it is ranked number 1 by FEMR rank within this sector and sub-industry. So we can get a picture of how things look, but let's now dig in. I'm gonna zoom in on this a little bit more. And here we're looking at the first one, and this is Ceres Group. And what we can see is it has a relatively low net profit margin of 5%, but when you compare it with the industry, it's about in line. Look at Tesla's at 6%, and the overall industry is at 5%. So in line net profit margin. What about return on assets? Well, the industry leader, which is totally dominant in the industry, is Tesla. And their return on assets is very low at 4%. And therefore, because Tesla is such a huge component of the industry, what you're going to see is that the industry ROA is going to be very close to Tesla's ROA, and it is at 4%. So Ceres gets an 8% ROA. Not bad. That's not easy to get. So now let's look at valuation. The first company, Tesla, is got a PE multiple of 295 and a price to book of 19 times. That is an insane level of valuation. And it is just, I've never seen it in my whole life. And most of us have never seen such a case where a company has been so highly valued. Now, what you can see is that if you look at the return on assets, it's actually pretty low when you consider how the company is. Now, this is a cyclical company, so you got to be careful because the demand for cars can drop off. And that's one of the reasons why car companies and autos tend to never trade at big premiums. In fact, there's some investors that completely avoid the sector because they don't want to go through the ups and downs. So let's look at Tesla's PE of 295 and price to book of 19. What does that tell you? Well, 19 is pretty high, but it's not crazy high. That tells me right there that actually the earnings are not doing well because PE is the latest earnings. And if the earnings are low and the price is high, then the PE is high. And that's validated when we look at the momentum measure of EPS, which shows momentum in EPS is down 60% over the past 3 months. You'll see the note at the bottom of this shows that I get this data from LSEG, and its sector data is market cap weighted, and the price change in beta over the past 3 months is what I'm talking about. I update this every week, so this was from the last update, 17 December. And this is the GST file that you can get yourself in Excel. Now, we can see the other crazy thing about Tesla is that despite EPS momentum being strongly negative, price momentum is strongly positive. So let's look at Ceres Group. 30 times PE. You could say, to me, that's still high compared to the fact, considering the fact that it's in a discretionary sector that can fall apart real fast. But because it's in a hot industry, which is the EV and electric vehicles and the like, it tends to be rated pretty high. And look at the EPS growth at 81%. So we have to look at PE in context of that growth. And with that strong growth, investors are willing to value it higher. And then let's use price to book to put it into perspective. Price to book of 7 times is a bit high compared to companies around the world, but compared to the industry average of 13.3, it's half. So you're getting double the ROA and half the price to book. But that's a little bit confusing because the sector data at 13.3 times price to book is being distorted by Tesla. And as I said, it's market cap weighted, so Tesla is a huge component. If we were to equally weight it, it would be a much different story. But it is best to market cap weight these types of things. So then it may be better just to look at Ceres compared to BYD, because they're both from China. They're both of somewhat similar size. And we can see that Ceres is a little bit more expensive, but we can see that earnings momentum is very strong at Ceres, and we can see that ROA is much higher there. And so therefore, you could argue that Ceres, in relation to the others, looks pretty attractive. But we're not here just to look at that one company of Ceres. What we also want to do is compare it to Trip.com, because it's such a different company and such a different industry that it can help us think about it. So let's do that. The next thing we'll do is look at the next slide, and what you'll see is I'm going to compare these two companies. So let's go through and look at the table. We can see Trip.com has a net profit margin of 52%. That's incredible. Now, that's because it's an asset-light business. It's got an ROE of 13%, which actually, to me, is a little bit low given it's an asset-light business. And then it's got a very low PE and a very low price-to-book multiple. So, in fact, it's also got earnings momentum of 88%, and the price has been moving. This is part of why it's an interesting company right now. But to expect that Trip.com will trade at maybe 30 may not be the case, given that even with this level of growth, the market is punishing the company a little bit on the PE basis. So let's look at this for a second. Ceres, higher PE and price to book show investors optimism for future expansion, and they're pricing in growth potential rather than current returns. So there's still hope that the company is going to have really strong growth going forward. And we know that that's the case, particularly because it's in this industry of the automotive sector. Now, let's look at Trip.com's lower PE and price to book reflect a mature, efficient business with steady profits and modest growth expectation. Now, the profit is crazy right now, but remember, that's just a very short period of profit. Never get lost in profit growth or profit collapse, like we saw Tesla collapsing, and we're seeing companies like Trip.com booming. Now, you can also look at Airbnb relative to it. So if we look at Airbnb, it's got a lower net margin, a slightly lower ROA, but yet 31 times PE and 9 times price to book. I would say that part of that is just for global investors may not find investing in a Chinese stock as attractive as investing in a US stock. And so there is some premium, I suspect, being paid. Now, let's look at Booking Holdings. And this is an interesting one because you can see NM. I put in NM meaning not measurable or not meaningful. And that tells me when I see price to book is not meaningful, it's because price to book is negative. And we don't generally use negative price to book multiples. Why would price to book be negative? Because the equity of the company is negative. Why would the equity of the company be negative? It's because the company has bought back shares at a relatively high price. And then when they've done that, they've written down their capital based upon the number of shares that they bought. It's not necessarily bad. In some countries, like Thailand, as an example, you're not allowed to buy back shares to the extent that you would make your equity negative. But in the US, it's just an accounting thing. So that just tells me that I can't rely on the price to book because their equity is negative. So really all I can look at, I can look at EV to EBITDA, I can look at price to sales. Those are different measures. But for right now, we're just going to use that PE. And I would say Booking and Airbnb are priced roughly the same. And you can see that Booking got an ROA of 18%. Now, some people say, why are you looking at ROA instead of ROE? Well, everybody looks at ROE, and it's a great measure to compare across every company, across every sector. But people oftentimes overlook ROA, and we overlook ROA because it's generally not a good measure across sectors. You know, there's no point in measuring a asset-light Trip.com to an asset-heavy, let's say, utility company. It just doesn't make sense. So ROA is going to be contingent on the structure of the industry and the structure of the business. But because I'm doing an analysis looking at each industry, I prefer to look at ROA. And also what it does is it removes the issue of the capital structure. I'm not concerned about the capital structure. This is also why we can use ROIC, return on invested capital. In fact, that's probably an interesting topic, is comparing ROA to ROIC. You can think of return on invested capital as ROA with adjustments. And maybe we'll talk about that at another time. So now let's look at this. So sector and industry matter. Trip.com's high margins and returns show an asset-light, scalable platform that converts low costs into substantial profits. And Ceres Group's lower margin and higher multiples reflect a capital-heavy manufacturer where growth depends on scaling production, not necessarily efficiency. So Trip.com shows profit scalability, while Ceres shows growth through capital expansion. That's what you're going to get in each. So remember, just send me an email that says GST, and I'll get you on the list so that you receive the Global Stock Tracker every single week like I do. And you can use that, just like I do, to evaluate companies and compare them. So that's a wrap for today. It's a day before Christmas Eve. And Mom and I practice, we celebrate Christmas, and we're excited for it. And tomorrow we're going to have a little party at home. So that's going to be fun. And I hope that you are enjoying the holiday season yourself and you have a great holiday season. Remember that the Valuation Masterclass show is sponsored by Valuation Masterclass Bootcamp. Next one starts Feb 16. Learn more at valuationmasterclass.com. And also send me an email if you want to get a discount of $100. And I'll see you in the inbox there. My name is Andrew Stotz, and I hope that you build a competitive advantage